When you want your spring break to feel like... and your kids' pool day to feel like... and your hotel bed to feel like... ooh, and room service to feel like... because at Hilton, hospitality feels like...
Your cabana's ready. Would you like fresh towels?
It matters where you stay. Book now at Hilton.com. Hilton, for the stay.
Hello, welcome to Fintech Insider Insights. I'm Ross Gallagher, Head of Consulting here at 11FS. As we all know, user experience is vital in fintech. It's an important part of what set apart brands like Monzo, Revolut, Nubank and up from incumbent banks in the first place. But as we enter 2026, financial services UX is entering a new phase. It's no longer just about making products easier to use. It's about designing experiences that help people feel confident, informed, and in control of increasingly complex financial decisions, particularly in the shadow of what is now a very uncertain time in the world. Today's episode is entirely forward-looking. We're sharing 6 predictions taken from our brand new 11FS Pulse report, diving into how we think user experience in financial services will evolve over the next year. Based on the patterns we're seeing across product design, user research, and the wider industry. To help us do so, I have a great panel of guests, featuring both the authors of the report, as well as a product leader from one of our favorite banking brands, who we've not only raved about in the report, but given a Pulse Star Award for their excellent onboarding journey. So first up, we have my 11FS colleague and 11FS Pulse Report author, Joe Colchester, Head of Product at 11FS Pulse. Joe, first of all, congrats on the release of the 11FS Pulse report. It's always very exciting. How did you find working on the report?
Great to be here, Ross. Working on the report was a lot of fun, actually. It's always fun looking back, but also looking forward and trying to be bold about the predictions coming. And it's an exciting time to be reviewing the world of fintech and financial services. So, it was very fun. We also had an additional section to this year's report where we would mark our last year's predictions, which kind of raised the stakes a little bit, holding ourselves a bit more accountable. So that was quite a fun element to it.
Yeah, I love that. Who doesn't love a prediction? I think it's always easier when you're looking forward than looking back, though, right? Grading yourself. Really looking forward to getting into the detail of the report. So great to have you, Coach. Also joining us today, we have the second author of the report, Oliwia Wasik, UX Research Analyst at 11FS Pulse. Oliwia, great to have you on the show. Maybe you could just tell our listeners a little bit about your role specifically within 11FS Pulse.
Yeah, of course. Thank you. Really nice to be here. So I'm a UX research analyst here at 11FS Pulse, where I work on understanding how digital banking products actually behave when people use them in the real world, and how people experience them, and also how we can maybe make them a bit better.
Love that, because it's such an important distinction, how we think things are going to sort of work and how we think people are going to interact with them, and then how people actually do when they're sort of out in the wild. Looking forward to sort of diving in, and thanks for coming on, Oliwia, and sharing your expertise and your perspectives. And next up, we have a brilliant guest from a brand that's UX we never stop raving about. It's a very welcome return to the show for Evan Simmonds, a principal product designer at Up. Evan, welcome back. It's great to have you, and thanks for joining us all the way from Australia. I dread to think what time it is there. But how are things going at Up?
Yeah, really good, thank you. Yeah, it's actually not too bad. It's about 9 o'clock here at the moment. It's been hot recently, so it's nice to have a cool day today, but Up is doing great. Yeah, we're pushing past 1.2 million customers at the moment. Many of them are younger Aussies. Still the highest rating banking app in Australia. We have really high referral rates, which is amazing. And we've got an exciting milestone coming up with our joint accounts, which we call 2Up. We're about to hit 100,000. So it's starting to see some real progress, I guess, in the multiplayer space that we've been focusing on. I think last time I was on, I was talking about Groups, which is our other multiplayer play, which had just launched. So, yeah.
Yeah, it's incredible. And the approach that you guys take to design that sort of interactivity, I think is really, really cool. I mean, I mentioned at the top that you guys got a Pulse Star Award in the report for that sort of amazing onboarding experience. It was called a quote, beacon of inspiration for banks looking to prioritize simplicity, establish a distinct tone of voice, and avoid drop-off. I mean, that's high praise. I'd love to sort of get your perspectives on, I suppose, how important that sort of onboarding journey is to Up, and maybe a sort of an ingredient to you guys' success.
Yeah, of course. Well, first of all, thank you very much for the award. We're very honoured to receive it. So yeah, really appreciate that, and the kind words too. Onboarding, it's a critical part of the entire journey with customers. So look, if we think about why, it's really about the momentum that customers have when they're signing up. We know that that's the point where they have that highest motivation to try and understand how, the product promise is actually going to relate to helping them. So, we put a lot of energy into that. And I think one area, like I said before, we have a lot of referral. One area where we try and, really shine a little bit more in our sign-up experience is just being a bit more relatable to customers as well. We know that we're different from the traditional banks, like a lot of neobanks are, and we want to try and get some of that personality across. So, you'd probably put it to two things. Like, we try and focus very much on speed and efficiency, so making sure that we really help customers sort of step through the flow quickly, get through the boring bits without really thinking about them, and natural language and making sure that really flows is important to us. But then on the other side of that, it's those little moments where we can give them those little sort of dopamine hits of encouragement to keep going. So when they get the account, we have this little moment, we call it a little up year moment, which is just a little celebration that they're here and that they're going to receive something that's quite different. So yeah, it's a big part of our experience. We have a team almost totally dedicated to it now. So yeah.
Really cool. I mean, that first impression is so important, isn't it?
Absolutely.
So, no, congrats. All right. Well, look, that's our panel. So I guess listeners, settle in. We're going to get into it. I think if you're a product nerd, and we assume that listening to this, you probably are, this one's going to be a good one. So in the first half, we're going to dive into 3 predictions that are going to directly change what users see, do, and feel. Our first prediction is that by 2027, the most meaningful shift in AI won't be better insights, it will be action. So rather than analyzing decisions or offering recommendations, AI agents will increasingly carry them out within defined parameters, triaging issues, reallocating funds, adjusting plans, or triggering preventative measures. Joe, I mean, it wouldn't be any sort of prediction show worth its weight if we weren't talking about AI. From a Pulse perspective, do you think we're already seeing teams move beyond AI insights more towards execution?
Yeah, I think we are, but I think it's not gone very far. I think it could go a lot further. We're seeing some intelligent things like kind of suggesting things through prompts about smart decisions you can make. But what we're not seeing is extensive actions and steps to take kind of sophisticated decisions on users' behalf that they can sign off. I think that's what's coming next. I think it will be disappointing if that doesn't happen this year. So we've got a few examples where actions are being taken, but they're pretty slimmed down at this stage. I think that's it's a cautionary approach, and that's the right one. But I think that's definitely on the horizon. I think that'll be the most exciting thing to see out of AI this year.
And Kolsch, I think one of the key things that stands out for me about the way that we've sort of teed this up is the bit about within defined parameters. I think we're not necessarily talking about you sort of just give the AI complete control over every part of your life. You go to bed, you wake up the next morning and it's done all sorts of things, right? We're talking about, within very, very strict controls.
Yeah, exactly. I think those need to be set to begin with. So kind of authorizing the app to do that on your behalf, but then also sign off at the end. It's a very risky state where things are all happening autonomously without any authorization and then final sign off. I think those two things have to be clear, and I think that the best UX will come out of how that's most intelligently done in a kind of very easy way.
Yeah. So Evan, seems a sort of natural point to sort of bring you in. I suppose from a design perspective, how do you start to think about creating some of those guardrails that lets AI act while still making users feel sort of like they're informed, they're in control, and can sort of, I suppose, push the pause button at any moment?
Yeah, it's a really good question, and something that, we're really starting to think about a lot now too. I think it sort of starts with understanding, I guess, their goals or intent. So I don't think we can really let an agent sort of take on responsibility for the customer without first sort of starting with what they're trying to achieve. And we do that a lot with like saving. We have savings goals, like, people, a lot of our customers are quite young and are looking for experiences like holidays and things like that. So there's certainly like areas that we can play in that I guess you could consider fairly low risk, which I think is a really smart way to approach it. I think there's sort of like maybe some tiers to autonomy. So, if we're talking about a customer who, for instance, is saving for a trip to Japan next year, they've got a date in mind, they've got a destination, you can help them understand the costs involved. But something like that is like, when we're very big on automation around paydays. So, if we can see that there is surplus at the end of a pay cycle, they're the kind of perfect opportunities where we could be like, all right, well, that's a fairly low stakes thing to take some of that money and shift it towards that goal. Whereas something that's far higher stake, like moving money to external investment accounts or, maybe a new contact, they're the kind of things where I think you have to put a lot more, I guess, customer control in place, if that makes sense. Or, a lot more stages of
that idea of tiered controls definitely resonates. And making sure, I like what you said about sort of really understanding that risk factor, and making sure that that's obviously factored in terms of how you design out those tierings. Oliwia, I'm really interested in, how do users, if we think about it sort of right now, how do users feel about, I suppose, handing over some control over some actions when it comes to, personal finances and money?
Yeah, I think people like the idea of AI taking friction away, making things easier and smoother for them. But just to echo what everybody else has said, I think trust drops sharply and frustration raises when action happens without explanation or, crucially, the possibility to undo it. So users are generally able to accept really even drastic actions like automatically freezing cards or flagging suspicious transactions because they understand that this is done, in their interest and on their behalf. But no one wants to be stuck in an AI loop from hell. When this action was taken mistakenly or something went wrong, you don't want to then be referred to another AI agent who doesn't understand the peculiarities of your own situation and cannot help you. So tight, visible boundaries, but also recourse for when things go wrong. I think these are the two crucial things.
Yeah, I mean, they're such important points. And I suppose, Evan, just coming back to you really quickly on the point around design, what Oliwia says about being caught in a sort of AI loop from hell, as much as we're focusing on sort of AI and the potential upsides when it comes to automation and all of those sorts of things, I suppose that has to be paired with some human support where there are those sort of, high stress, high anxiety, sort of high impact moments.
Yeah, absolutely. And I mean, that's probably one of UP's strengths is we have invested a lot into that human support side of things. So, and we really sort of focus on that feeling very relatable and approachable. And so I guess if customers know that support's there, like the hard problems are much easier for them to reach out to us. But yeah, I mean, also you need to, visibility and the ability to just switch things off is obviously going to be quite crucial as well. Support is not always immediate. We'd like it to be, but yeah.
Love it. I mean, this is the great thing about the Pulse report, but I suppose the format for the show is I think any one of these predictions we could talk about for the entire show. So it may feel a little bit swift, but I'm going to move us on to our next one. So the next prediction from the report that we want to dive into is that investing will become a new battleground for banking apps. So in 2026, we're expecting investing to be sort of normalized inside everyday banking apps, blurring those lines between saving and investing through low friction guided experiences. Colch, look, from a pulse perspective, are we already starting to see some early sort of signals of things heading in this direction?
Yeah, I think we are. I think Monzo were quite an early mover here, and they've done very well in simplifying their product offering when it comes to investments. I mean, for example, Zopa, recent entry into the market, they're offering investment off the get-go to suggesting that that's something that there's an appetite for. Chase UK further integrating Nutmeg. So I think that's a good example from the UK, but also further afield. I think Nubank are doing something similar as well, where they are integrating these investment products, often simplified, which is probably a good thing. And there's some momentum there. And there's momentum in terms of the product releases, but also I think the behavior around it. People finding actually they do have some surplus money. Their interest rates might not be very good. There is encouragement, whether it's a policy from within a country about investing actually is being more encouraged. So I think there is momentum building as current accounts and banking apps start introducing these features. So I think that's something where I think that will be a new battleground. I think something to look out for, though, is that a lot of existing trading platforms, things like Trading 212 and Robinhood, for example, they're starting to offer prepaid cards. So it's interesting that it's happening from both sides, and often the perks from these trading platforms when it comes to current accounts prepaid cards can be quite significant. So the race is coming from both sides, not just from banks, but also from trading platforms themselves to win over customers.
Yeah, super interesting. I've been kind of saying for a while that I think investments have a bit of a personal branding problem. All we've talked about for a really long time is the risks, and the value of your investment might go down as well as up. But I feel like we're starting to shift away from that a little bit. And absolutely the examples that you gave, making investments options available in the sort of like the everyday sort of mobile banking experience. The Zopa example is a really good one, where they're partnering with Invesco to make their funds available, and sort of making it more accessible, because it is a great tool for certain people to sort of grow their wealth, etc. Oliwia, from the user research that you've seen, what emotional barriers, though, still exist around investing? And I suppose, have you seen any good examples where brands are starting to try and counteract that?
Yeah, I think the biggest emotional barriers are fear of loss, fear of getting it wrong, a sense that investing is something for other people. Culture plays a huge part of it. I think that is often overlooked. Americans overall are better than Europeans at investing. Western Europe is better than Eastern and Central Europe. So when you're designing these products, I think culture is something to keep in mind. I think many users still associate investing with high risk, insider knowledge, irreversible mistakes, losing all of your money, quite drastic, like big things. So what works well is actually reframing investments as an extension and a continuation of saving, better than, a large leap into something completely unfamiliar. So what works really well from the examples that we've seen is brands that focus on guidance, really small steps, plain language, and progress over time rather than kind of performance obsession. So features that normalize small, low-stakes entry points and try to keep users engaged and really calm, right, to not dump those investments when the market takes a downturn and so on. So that really helps to reduce that anxiety and build confidence without pushing users faster than they're ready to go.
Yeah, I love that. The cultural point is so interesting because, so much of that is kind of inherent, isn't it? And almost like generational, and the difference between the sort of different parts of the world and their mentality towards it is so interesting. But totally understand what you're saying about the sort of maybe more like iterative sort of like behavioral design techniques, starting with a little bit, sort of growing it over time, all of that sort of stuff. Evan, are you guys seeing a sort of a growing demand from customers for investing, and I suppose to live alongside that sort of like that everyday money side of things?
Yeah, definitely. I think we see, like, sort of to echo those points from Oliwia, we see, I guess, passive investing is an extension on savings. So the way we've typically thought about it is, investing for young people is potentially either a scary thing or something that can almost borderline gambling at some points when I guess we think about crypto and other sort of assets like that seem to bounce up and down so much that it becomes very speculative. So we think a lot about our customers and their financial well-being, and thinking about how we help them, I guess, increase that knowledge and make better decisions without having to do too much of the hard work. We call it, easy money. But I think where investing really fits nicely for our customers is in that sort of low-risk ETF kind of part of the market. So if we can present that sort of thing to them, in a way that is really easy to understand and understand that it is low risk, then that's really important. But I think the other point is there's a bit of a friction sort of paradox with investing, and that is we want to make it super easy for customers to get that money into that sort of passive investing. But if they're going to keep dipping in and taking it straight back out, then they're losing all of those gains. It'll go to tax, etc. So if we can kind of really reduce that friction to zero when getting into the market, if that's micro investing, but we can make it a lot harder for them or make them think a lot harder about taking that money out, then that's the kind of thing that we would prioritize. So, I mean, what that means in practice is probably, more like creating a front end that doesn't talk to, like Oliwia said, doesn't talk to market changes. It looks to the long term. It tries to talk to that future you rather than the person who's investing today. And making sure that we're introducing it at the right time as well. There's no point a customer investing if they haven't got that sort of savings buffer in the first place. So making sure it fits is really important. Yeah.
I think that's such an important point. You can't talk about investing in isolation. I think you need to know that you've got that emergency fund there that means that if for whatever reason you do need quick access to cash, then it's there and you're not pulling it out of investments, and you sort of set up in a way to enable that sort of longer term sort of investment strategy that I think is really so important. And I think probably, pairing that then alongside some of the stuff that Oliwia was talking about around guidance and sort of education and helping people build those sort of those better financial habits and behaviors, and moving away from the more speculative end of it towards that sort of that longer term view. I'm going to move us on. So our final prediction is pensions remain the biggest untapped engagement opportunity. Now, we said in the report that pensions hold enormous value, but engagement remains incredibly low. We believe that only changes when providers shift from abstract balances to lifestyle-led progress and reassurance. Oliwia, I'll come to you first on this one. Again, from your research, what do users sort of actually want to know about their pension? What do they care about?
I think it's surprisingly simple. It's just, am I going to be okay? So, people don't care about fund names, contribution mechanics, the squabblings over legislation and so on. It's more about whether their pension is going to support the kind of lifestyle and the life they imagine themselves to have. So really they want kind of reassurance, clarity, and progress that they can understand, like you said, in life cycle and in lifestyle terms, rather than charts and progresses and so on.
Yeah, so interesting. I think you're spot on. I think when it comes to, it's so difficult almost to sort of crack a lot of the language and the positioning around pensions, because it does focus on things like the mechanics and portfolios and all of that sort of stuff, rather than where does this get me to in retirement, and is that going to enable a comfortable lifestyle? Colch, why do you think, people don't tend to engage, or seemingly don't tend to really think about or care very much about pensions relative to almost any other financial product?
Yeah, I think it's one of the sort of most long-standing branding problems in financial services, where you can't mention pensions without someone sighing quite deeply and wanting to move on really quickly. And I think it's got that branding problem because it's so long-term. It's never been presented as something that's particularly interesting or worthwhile to dig into. It's so removed, and I think that is addressable by communicating it in the right way. So it's got that. It's not a problem right now, so I don't have to think about it. But actually, there's good product decisions to be made. There's a lot of guidance that should be there, and people just put it at the back of their mind. And I don't think we're going to see a lot of progress this year, but maybe there'll be a couple of trailblazers who kind of who integrate it more interestingly, present the facts and the kind of decisions that people should be making in a more compelling way. That's more of a hope than an expectation.
Yeah, I like that though. It's good to be optimistic when it comes to our predictions and sort of hope that we start to see some movement towards some real sort of solving for some real financial problems. I don't know how many times or if we've ever really referenced Jimmy Carr on the show, but I saw a really good clip where for anyone that doesn't know, he routinely gets sort of heckled at his shows. People shout out random questions. And the sort of question that was shouted out was, what piece of advice would you give? And he said, well, if you distill down the key messages from basically every self-help book that's ever been written and pretty much all of the major religions, it boils down to prioritize later. So the whole thing is just like make a sacrifice now that gets you in a better place later on. But I think understanding that as a concept, but then, sort of putting things in place that sort of counteract what is human nature, which is I'm going to prioritize right now, aren't necessarily the same thing. Evan, if you were designing a pension experience today. Oh, yeah, of course. Olivia, come on in.
Jump in on that. Thank you. Sorry. It's just, I think it's interesting because there are very difficult things to engage with for young people and older people for different reasons. So it would be nice to see some sort of, emotional messaging around those. Because I think for younger generation, there's a sense of financial nihilism. It's the kind of like, well, I see the kind of lifestyle that my parents have unavailable to me. And so what does it matter if I have a pension or not? And, I might as well spend this money or not care. And for the older generation, it's really a lot of anxiety about aging and uncertain future and, your productive, like your work life coming to an end. So it's such an overlooked product. And it's interesting because we've managed to rebrand fitness, right? Like 10 years ago, nobody cared about fitness, but now everybody understands that you need to lift and you need to like really take care of yourself so that you can lead a nice, healthy life until your old age.
Yeah, and it started with such a simple concept, like 10,000 steps, and it kind of grows from there, right? But you're so right. I mean, connecting with people, particularly about lifestyle and retirement and those types of things on an emotional level, because all of that money is inherently emotional. But also then, I suppose, contextualizing it in the brutal realities of, what the sort of financial future that different generations are facing into, because they are entirely different. As you say, I think those are incredible points. Does that sort of resonate, Evan, with you as well from a design perspective?
Yeah, it's kind of interesting actually, because we have quite a different environment in Australia. I don't think we can say this too often, but we're probably kind of world leaders in this one little niche.
Love that. Congrats.
So Australia has superannuation as a compulsory thing linked to your salary. So you're getting paid 12% of your salary every time you get paid into your super. So we've kind of removed a lot of the need to encourage people to start doing it because it's just happening automatically in the background. So the bigger problem, or maybe the bigger opportunity, is probably more around, it's very similar to investing, really. It's like super is actually very similar to, passive investment, except it actually has the added benefit of not being able to remove that money until you're retired. So it's, in some ways, that sort of perfect product where it's easy to get in because you're automatically getting in. There's actually a lot of tax benefits to contributing as well. So it's probably the first thing that you look to do outside of, say, saving for a home deposit is like seeing how I can save on tax through super contributions. So in Australia, it's more about like how can we help customers sort of take ownership of it and actually not neglect all of those savings that they could be making through super. So some problems are still the same though. Like it's still like people can't imagine, young customers can't imagine their future self. So there's some really good regulation that's coming in this year actually in Australia around making sure that your super is paid on your payday as opposed to paid quarterly. So there's an opportunity there to really start linking that super contribution with your pay. So, you could be talking about your salary today and your salary for that future you and the lifestyle that affords. So, there's heaps of opportunity actually. And sorry, I could probably go on about it, but there are also players that are doing some really interesting things around, aligning super and where that money goes to their values as well. Future Super's a great example of that in Australia. So, yeah, pretty fertile ground here at the moment. So we're certainly,
I agree.
Certainly thinking about it.
I think as an industry, when it comes to pensions, I don't think we've been ambitious enough. We've almost kind of been defeatist. I think we've kind of gone, people don't really get pensions and they don't really care about it. Like, it is what it is. That's a shame. And then we've just sort of carried on. But I think back to everything that you guys have said, I think like if this is even just like a small call to arms to that corner of financial services that says, guys, I think we can do a lot better here, then I think definitely worthwhile, Coach, to your point. All right. So look, go on. Nice and quick though.
Oh, sorry. I was going to say, I think there are some ways of approaching it, which is just to visualize it more. I think we saw that from the likes of Tembo when it came to mortgages, which is to make seemingly distant objectives actually achievable by kind of breaking it down into individual parts, whether it's certain life goals and how that might relate to pensions. I think there is a user interface solution to that we're not quite seeing at the moment.
Couldn't agree more. All right. Look, in this half, we have talked about the changes that we think will directly shape how users interact with their banking apps. After the break, we're going to zoom out and we're going to look at the infrastructure shifts that are quietly reshaping financial services UX, often without users even realizing it. So stick with us. Don't go anywhere. We'll be back very shortly.
Hey folks, David Breer here, CEO of 11FS. Here's something you might not know about me. I get a lot of people trying to impersonate me online, fake profiles, scam emails, the lot. And a big part of that comes from data brokers, hundreds of them, quietly collecting and selling your personal information. Your phone number, email, home address, job title, all out there and all fueling identity theft, scam calls, and spam. If you've ever searched your own name online, hands up, who hasn't? You'll know how exposed you really are. That's why we've partnered with Incogni. They contact 230 plus data brokers and tell them to delete your information properly and legally under GDPR and CCPA. Doing it yourself would take hundreds of hours. Incogni automates the whole thing and keeps working with repeat removal requests if your data reappears. I tried it and within days saw brokers deleting my data. You can even protect your family members too. Fintech Insider listeners get 60% off an annual plan. Just head to incogni.com/Fintech Insider and use code Fintech Insider. And yes, it's risk-free with a 30-day money-back guarantee. You'll find the link in the description.
All right, welcome back. In this half, we're going to look at some of the big infrastructure shifts that could redefine how people interact with financial services. So let's kick this half off with one of the more controversial predictions in the report, which is the rise of prediction markets. So by 2027, we're predicting that prediction markets are likely to become a more visible layer of financial decision-making, used to forecast everything from elections and economic outcomes to business performance and real-world events. But as they move towards the mainstream, they continue to blur the line between trading and gambling. Culture, I think, look, when it comes to prediction markets, probably a fairly new phenomenon. For anyone who hasn't heard of them, maybe you can give us a quick sort of 101. What are they and who are the major players?
Yeah, pretty new phenomenon, but have kind of really rocket shipped into action, actually. So all eyes on prediction markets at the moment. As you say, they basically let people trade on real world outcomes like elections or economic events, sports events, right until, very, very seemingly meaningless kind of will it happen, will it not, moments that can often be user created. So It's essentially gambling products placed within trading and investment platforms. And key players, things like Kalshi, Polymarket, Robinhood, and from the kind of sports angle, things like DraftKings, but I think there are more emerging. And they're gaining a lot of visibility. And they kind of sit in that awkward position between finance and gambling. And that's why everyone's talking about them, because they might not have the same guardrails that should be in place for gambling because they exist within trading platforms.
Evan, I think it's interesting because there's definite parallels to maybe some of the more speculative behaviors that we talked about when we were talking about investments. That gambling angle is always controversial. I'm interested in, I suppose, again, from a design point of view, are there areas we can take from within sort of existing financial services or gambling UX that we can start to maybe just nudge this in a more responsible direction?
Yeah, sure. I'm going to start by saying I had not heard of prediction markets until I saw this podcast. So this was totally new to me. And then I saw them everywhere. I was watching the UFC on the weekend and there's Polymarket everywhere. I'm like, wow, okay, it's a thing. Okay.
Yeah, when you know, right?
I'm certainly not going to come to this with an air of authority, but I can obviously try and through that limited research, try and understand what's going on here. So, I think there's something there. Like, I kind of understand it. Like this whole wisdom of the crowd. Like, if there's enough bets being made on either end, then somehow there's some sort of truth in the middle there. I mean, I'm still trying to fully understand what that means, but it sounds like there is like an actual benefit to be made through these markets, but they just look like that guy walking down the street with you who just wants to put a wager on everything. So, I would say, looking at what is out there today and thinking about the word responsible, I think you would look to gambling as what not to do and start to look at if you were to make a responsible one and you were to try and, bring forward the benefits of placing serious bets on things to try and help, forecast what might happen, then I would say, like, interrupt that animal brain as much as possible and remove all those, adrenaline and dopamine cues that you see. We don't need trending. You don't need a million different things that you can wager on. I think if you can sort of start removing a lot of the, time constraints, all of those sort of things that make people be impulsive, then that would be a good start. And then I think maybe you could try and weed out the serious people from the ones who are just wanting to make the wagers by, maybe borrowing from video games a bit more and thinking about how you could sort of create that, simulated learning, onboarding that's like, not necessarily using real money and making someone actually understand what they're doing before sort of committing to using these platforms. So, yeah, I could probably go on, but like it's a weird area. Like
it is, and I think, look, for it to come across as legitimate and responsible, the point that you raised around like the sort of time constraints and those sorts of tactics that you're almost more used to seeing from like scammers and fraudsters, then I think absolutely we need to move away from those. But no, those types of design considerations I think are going to be really important. Oliwia, what have you seen in terms of how people actually engage with these markets? Is it more sort of like the information piece, like Evan was saying, or is it really just that sort of more gambling behavior?
Gambling, 100%.
Right. Easy question to answer.
Yes. So just for a bit of a background on prediction markets, they argued that they're not betting because you're entering with a contract against the other person, right? Because you're trading on a binary outcome, they're saying. Rather than against the house. So they fall under the Commodities Futures Trading Commission, which doesn't have provisions against insider trading. And now they have official sponsorships and partnerships with CNN, CNBC, the Golden Globes, oddly enough. So this is why they worry me personally. It's because the official language and the official positioning in terms of legislation is as a trading platform, but really everything else is gambling. And that's how people engage with them as well. So the mechanics, the language, the emotional dynamics, that's all taken from gambling. Quick outcomes, probabilistic thinking, the rush of being right, the kind of impulse to, if you didn't get it right, to get it right the next time. So that doesn't mean that they can't necessarily provide insight, but from a user mindset perspective, it's pure gambling.
Yeah, it's an interesting one. I mean, it's an interesting prediction. I think it's one that is gonna run and run. I think we're gonna have to keep an eye on it. The worry, obviously, Oliwia, is what you said, that they're almost getting around some of the key important regulation by way of a sort of loophole, which is always a worry in terms of the potential damage for users and consumers. So I think one will definitely need to keep an eye on. Right, our next prediction is that stablecoins and their rise as financial infrastructure. So in the report, we said that by 2027, stablecoins will operate behind the scenes as financial infrastructure, reshaping payments, treasury, and cross-border money movement without users needing to think about crypto at all. Culture, I mean, this feels bang on trend. Are we already starting to see some stablecoin-like infrastructure influencing those mainstream products?
Yeah, I think we are. So Visa now settles payments using USDC. So a lot of that's happening behind the scenes. Users would never realize that, but it's actually fundamentally shifting the infrastructure behind the scenes, finally, because there's been a lot of talk, a lot of hype. And I think now we are actually seeing that come into action. And I think that will only increase this year as efficiencies identified and opportunities are seized. So yes, I think that's really going to take shape. It will still largely happen behind the scenes. I don't think users will really notice, which is great. They're not there to be noticed. They don't need to be told even. But I think it will play an important role. Particularly, I think, with international transfers. I think that's where the user is set to gain the most by kind of gaining off the opportunities of stable coins and the beneficial rates that they might offer.
Yeah, I mean, Evan, I think Cold for me raises a couple of important points. I think as an industry, we're naturally sort of obsessed with the tech and the rails and all of that sort of stuff. But I mean, from the end user's perspective, they're not too worried about that, are they?
Yeah, I don't think so. I think that's what is probably why it's more likely to succeed, is that it is invisible. As speed, removing those middlemen from the equation to reduce cost is also super appealing. I guess, with speed, there's also that, downstream effect though that comes with, the risk of being irreversible. So I think as we adopt this sort of technology, I certainly know from working in payment security in our teams how much attention we've put on that, and I think it does make that process potentially become harder. It depends on where I guess it depends on where stablecoins fits into that middle territory. If there's enough sort of like gates in place, then maybe it's not as big a problem, but it certainly would make us focus more on like making sure that we're protecting customers before something goes wrong. For an example, investment scams are a huge problem for us. And if that money can get out overseas, next day, instantly rather than in a day or two's time and is irretrievable, then that's a really bad outcome for quite a lot of our customers. So I guess they're the things that we would look at. They're the risks. But I think I'll give you an example, because this is something that I'm still trying to understand, but seems like a really big opportunity. Is we have a spendable balance where we for customers, and what we do here is we take their available balance, we project forward and look at all their bills, and we say, all right, this is what's safe to spend. The problem with that is they can still go out and spend that money. That reserved cash is still there at a tap of a card. Like it's not safe. We can introduce products, which we do, around separating that money into different areas with a different card, separate account, etc. But that comes with a whole bunch of problems as well, and all the the maintenance that comes with that sort of thing. So I think if stablecoin can sort of embed that logic to the money and say those reserve funds, they're actually just reserved for this specific thing. And if the user goes to tap their card, then those reserve funds are actually off the table. That sort of thing seems really appealing to us. Yeah.
So that shift more towards kind of like programmable money.
Yeah.
But then the other point as well that you called out that I really liked was about putting the relevant controls in place so that people are protected before they sort of, and I think we're starting to see some good movement in that direction from like Revolut with their sort of like street mode, which is like if you're not in a safe recognized space or if there's a transaction over a certain amount, they'll sort of put a hold on that for an hour or whatever it is.
Yeah. Prevention becomes a really big thing, but it's hard. Like prevention is hard when you're talking about investment scams because these scammers are very motivated to convince, over a long period of time to convince these people that they're doing the right thing. So prevention is tricky. It's a tough problem. And so like reducing the friction to get that money out means we've got to get smarter about how we identify those problems before they happen. So it's a hard challenge.
It is. Oliwia, what about from that sort of user angle? Does sort of hiding complexity tend to build trust, or does it actually risk undermining it?
I think generally users don't really want to see the plumbing. They just want to know it works, right? And that if something goes wrong, somebody can explain to them. Like as long as transparency is still available, still on the table, should they need it, there's no problem in hiding complexity because nobody has time for that.
Yeah. No, I couldn't agree more. All right, look, the final prediction already, I can't believe we're here. So we're going to dive into wealth management crossing the final frontier. This means that the next wave of wealth competition will focus on integration and in-app distribution, bringing private bank-style personalization to mass affluent users. Talk about a call to arms. Coach, from my previous one, this sounds like, yeah, come on guys, we can do this, and I like it. Evan, have you seen sort of growing demand from customers for those more sort of like personalized, maybe more of that sort of like white glove experience in financial services?
Yeah, I don't know if we're seeing growing demand as much as I think we're starting to see a shift in expectations. Like if you look at the way young people today, young Australians are using things like ChatGPT, just the absolute adoption of these sort of tools where they can be asking advice on almost anything is becoming more and more common. So I think those expectations, like we often sort of compare our app with like, what are the other apps that customers are engaging with on their phone? And that's increasingly becoming something they're doing. And so like those expectations tend to bleed into other areas. And I think that's where, even if we don't necessarily see the demand, we know the demand is coming because, if you can get that experience elsewhere, why can't your bank help you? So it's something that, so that's definitely something that makes us think about it.
Yeah, I definitely agree with that. That the particularly with the kind of great wealth transfer, people are expecting a lot more of digital experiences because they've experienced that with their regular bank. They're getting it elsewhere, and there's definitely that demand and expectation, and it's going to grow. So whether the tech can keep up with that expectation remains to be seen, because the challenges are enormous. But certainly, it will be demand driven.
I think it's so interesting because and that comparison to what's happening in other apps and maybe in other industries. I think within financial services, I think we can sometimes tunnel vision and we'll just look at what are the other financial players doing, and sort of that's, I suppose, the outer bounds of sort of our ambition from a UX design perspective. And sure, look, obviously, heavily regulated industry, there are restrictions on what you can and can't do, but that doesn't mean that we shouldn't try and take wider inspiration where there are opportunities to deliver more sort of seamless but also richer experiences for customers. Speaking of customers, Oliwia, what are you seeing in terms of what are customers looking for in terms of like guidance, advice, particularly I suppose within their banking apps?
So I think they want more advice rather than more guidance rather than full financial advice. So we're moving from show me my money to show me how I can be better with my money. And nothing makes me sadder than going on a banking app and seeing, a static link that says, trouble with money, here's some guidance. And it's just the most generic kind of thing that really gives you no guidance, in fact. So users want to see just more personalization, more understanding of their own situation, and for their bank to surface kind of relevant nudges when the occasion arises. So here's some surplus cash, exactly like Adam was saying. You can invest it. Here's, you have a big event coming up. Here's a plan on how to make it happen. So I think it's more of that rather than full-scale financial advice.
Yeah, nice. I mean, it doesn't feel like, Coach, like we're sort of making rapid progress in this space. Why do you think it's been so hard for banks to sort of integrate some of these techniques into the day-to-day banking experience?
Well, I think when it comes to, for example, high net worth individuals, I think their wealth is often spread across multiple jurisdictions, multiple countries, and that introduces enormous tax problems, enormous complications tech-wise. And I think that often you actually do need a human being to then step in and give very, very specific advice on that. To try and just digitalize that from the get-go is very, very hard. So that expectation may still require a human being there to be in the middle because of the enormous complications around it, I think. I also think, just building on the point about people relying on things like ChatGPT, I think there is going to be a little bit of a race there where people will assume their own risk, and whether it's investment advice, but also kind of setting up their own agentic AIs, kind of setting up their own trading protocols where they can assume all their own risk and take it away from the institutions. That's going to be a little bit of a race where people take on their own risk there, I think.
Is that it's almost like a sort of a bonus prediction. So people are going to start interacting with their own AI agents. The financial services institutions are going to get completely disintermediated. And that's the dystopian future that we have to look forward to.
I think that could be a bonus prediction, yeah. And that's where a lot of the headlines will be, I think. People making huge gains or huge losses off their own assumed risk, setting up their own agentic AIs.
And look, even if it's not necessarily in the full sort of AI model, we are definitely already starting to see people using AI tools to sort of like pick stocks, rebalance their portfolios and all of that sort of stuff. So I think we're already starting to see a shift in this direction, not necessarily en masse, but certainly some canaries in the coal mine. So I think, again, potentially a really interesting one to keep an eye on. All right, that wraps up today's discussion. A big thank you to our panelists for breaking down this very important sort of topic, talking through the predictions from the 11FS Pulse report. Guys, thank you so much for joining me. Let's do a quick whiz around the virtual room. Where can people maybe connect and find out a little bit more about you guys and your companies? Joe, let's start with you.
So you can find me on LinkedIn, Joe Colchester, or you can find Pulse at pulse.11fs.com.
Perfect. Oliwia, how about you?
Same thing, actually. Pulse or LinkedIn.
Perfect. All right. Easy peasy. And Evan, how about you?
Yeah, LinkedIn is probably the easiest spot to get in touch with me. Yeah, Evan Simmonds. I mean, if you're in Australia and you haven't downloaded yet, get on it. Just go to the App Store. You'll find it.
Awesome. And yeah, look, continuing the trend, you can also find me on LinkedIn. Thank you very much for listening. If you want to learn more about our predictions, then download the 11FS Pulse report right now. We'll leave a link in the episode description. If you like what you've heard today, please follow our podcast on your favorite platform of choice. And if you really like what you've heard, why not share this episode with a colleague or friend? As always, if you want to join the conversation, find us on social media. Just search for 11FS or Fintech Insider, or email podcasts@11fs.com. Thank you very much, and goodbye.
Retail investment in the UK is the lowest in the G7. According to the Bank of England, there is over £280 billion sitting in UK accounts earning no interest. Something has to change. Financial firms in the UK must look at making investing accessible, contextual, and trusted through everyday platforms. That means bringing investment journeys to the point of need, alongside spending, saving, and budgeting, and within platforms that already play a meaningful role in customers' lives. We dive into this and more in our latest report, Taking Advantage of the Embedding Investing Opportunity, produced in association with Secor. Download your copy today at 11fs.com/embedded-investing.